Welcome friends to the final video of the class, and it's completing your financial plan. This is going to be a quick video. Please read through the chapters of the book to get a in-depth understanding. But here we are at the end, and we've come through a journey, I believe. We've come from the basics of personal finance, figuring out how to budget our money, how to do career searches, taxes, through debt reduction, and I hope that's been helpful, how to eliminate debt throughout our lifetime, better purchasing strategies. You now have an investment plan, investment strategies. So let's just wrap it all up here in the final video of how to complete your financial plan. So let's look at retirement. Retirement planning starts very early in life because there's many misconceptions. What people have retired before, like my parents, versus what your parents, versus what you will retire. It's just different. You know, many times expenses decrease when they retire, when people retire, but that's not so certain anymore. It's expensive to live, and you've got to figure out how to keep money coming in, I believe, because some people think, well, my retirement only lasts 15 years, and sure, if you retired in the 1970s or 1980s, that was a different cohort, and many retirees simply didn't live that long. But we are living into our 80s and even 90s, and centennials, which are 100 years and above, is a very fast-growing demographic. So we're living longer. And of course, will Social Security and my company retirement pay for everything? For my basic living expenses? Hopefully, but we have to start planning very early and doing a few more things than just waiting on Social Security itself. So, as you start your work career, and for those of us who are already in it, you have to think about retirement. And when you get your full-time professional job, you may be offered one of two options, and that is there's a defined contribution plan for your retirement. Now that is what we call a 401k. That is if you're in the private sector. If you're in the public sector or nonprofit sector, it's called a 403b. These are just numbers that the Internal Revenue Service uses. They're not investments, they're just categorizations. Okay, they're categories. They are cash accumulation fund where your employer may match, hopefully will, your contribution. So you put in money and your employer puts in money. Defined contribution. Now, there's something called a defined benefit plan. This was what basically was the workhorse for the majority of American companies, back in the 50s, 60s, 70s, and 80s, and that is it's a pension, which means you work for 20, 30 years at an organization, and you basically would receive a pension for the rest of your life, and it's basically somewhere between 50 to 70% of what your full-time earnings were. It's an average, but you get that for life. So defined contribution and defined benefit. Today, it's mainly a defined contribution plan. Let's kind of look at that. So your defined contribution, again, 401k, 403b, there's also some government sectors have 457 plans. They're accumulation. It's like that piggy bank right there. You're basically putting your money in this, right in here, and then your company puts money in. Okay? So, what you can do is it's generally managed, the 401k, by a third party. And this is why you want to use the stocks or mutual funds for investment. So you want to use that mutual fund strategy that we talked about. Go back and look at those videos where you get 25% into a high growth fund, 25% to blue chips or international funds or bonds. You have a lot of diversity, and you put that into your 401k or 403b. I'm putting right in here, be careful of using your own company stock for your retirement. So let's say you work for a private company, fantastic, and they are saying, go ahead, every dollar you put in is a dollar into our stock. Well, it sounds great, but have we mitigated, what have we done to our risk? Are we making it more risk or less risk avert? You know what I mean? It's much riskier to do it this way because now your current future income is now based everything upon that stock. And companies love for you to do this, by the way. Why? Because it gives them more capitalization in the marketplace. So it makes their stock look stronger because they may have 10,000 employees all investing every single month in their stock, and it gives them more liquidity because that money goes right back into the company. So, a small portion maybe of stock for your retirement in your company, but the mutual fund strategy will give you the most diversification. That's the word I'm looking for your mutual funds. Okay? And there we go. There's the strategy that we looked back in the investments that we talked about. Diversify, diversify, diversify. So, on the defined contribution plan, always match to your company. Okay, this may be a question I think that you have in one of your assignments. If you don't, and most people do not, most people put a little bit in, especially when they're younger. And we know the time to do it is when you're younger because you get that long-term doubling of all your money. You get the great compound interest. But most people don't. They say, you know what, I need to take a vacation. I need to do some other things. And I get it. But let's look what happens when you don't match to your company. So your company will match 50% of your contributions. You can contribute up to $10,000 a year. Let's just say that you can, based on your salary. And then the company would go ahead and invest $5,000. So you invest 10, they're taking 50%. Wow. All right, great. You basically got an extra $5,000 from the company. So now you got $15,000 a year, and they're in those mutual funds, and they're in or the other stocks you pick, whatever you're doing, but you're getting a lot of growth. Let's say you contribute only $4,000. You didn't do 10, you did 4. That's pretty good. Then the company only matches $2,000. What you've basically done, what we've all done if that happens, we just gave back our company $3,000 by not contributing to the maximum amount. Okay? You understand what I'm saying? Absolutely. And it's just habit. But if your company matches, go to the match, let them match totally what they'll do. There is a finite amount that they'll do. And let that thing roll, my friends. Let that roll. Now, in a defined contribution plan, you can outlive your money. Now, what I'm saying here is, let's say when you retire and you've done all this, you may have that $2 million. Remember the, Jimmy and Jerry, our first example that we had in the first video, that they both put in $2,000 and they had that nice, let's say you had $4 million or $2 million or $1 million. Let's just say $1 million, it's the easy number. And then you retired at maybe 60 years old and you lived to 90. So you had 30 years that you lived on $1 million. Well, all of a sudden, when you start doing the math, it can really go pretty fast, because once you spent your money, you've just spent it. So there you go. You could spend that $1 million by spending basically $50,000 a year, and yeah, absolutely, in 30 years, you'd be without a cent. So be careful. Keep working as hard as you can and put as much as you possibly can into this fund. That's your 401k. Same as the 403b, my friends. Whatever the organization matches, you match. You contribute fully. Now, defined benefit is the traditional pension. Those are income streams based on your current working income. All right? Traditionally, companies take an average of your highest salaries, usually a 3 or 4 year average. So if you have an average salary for the past 4 or 5 years, as you're leaving the company of 75 grand, and you worked long enough, and you got an 80% percentage that you would get 60,000 for life. The nice thing about a pension plan, and again, they're pretty expensive, and that's why companies just don't do them anymore, is because if you live to 90, you're still getting 60 grand if you live to 100, you're still getting $60,000 every year. These are guaranteed by the federal government. So you cannot outlive that plan. Also, if you are married and your spouse, partner, or you die beforehand, you can generally ask for a surviving spouse, and they would get a percentage of that. Like instead of 60,000, they would get maybe 40,000. They get another 80% of it, or 75. And you can elect that. It gives you a little bit less per year, but it also makes sure that your spouse partner is is covered. And that's how my mom lives right now. She's living off my dad's retirement, and who'd retired in 1990. So actually, I did retire in 1988. So that's been a long time. So you cannot outlive this plan, right? So this is a nice plan to have. The drawbacks to it are you have to work for that company. You basically you're devoting your whole career, pretty much, a good 20, 30 years to that organization. So those are the two types of plans you're probably going to be offered. Now you know a little more about those. Again, most people change jobs, and that's why the 401k is very nice, because the 401k can be portable. It really is. So when you change jobs, you can move your 401k. Sometimes you can move it right into your next 401k. All right, that would be great. Or you can roll it over into a traditional IRA, which is always good to have, the traditional and the Roth IRA. You never, my friends, you never leave your retirement plan with the previous company. Now, the previous company would like for you to leave it with them because that's more assets they have. So, you worked 5 years, you've got $20,000 saved up or $30,000 in a 401k, and you get another job with another company. What you do, now you have a termination, right? You have a separation right in here. What do we do with this? Do not cash out. If you cash out, you're going to pay all the taxes and possible penalties. So basically, just say that's going to be a 50% penalty with taxes. So that 30,000 you have, you get 15. There you go. You may be able to roll it to a new employer's 401k, and you would simply contact them. As long as it's there, it's safe right in here. You contact the new company and say, hey, can I roll that over? They may or may not accept that, but you can always roll over to a traditional, must be a traditional IRA. And again, IRA, 401ks, these are numbers that are categorizations of the Internal Revenue Service. Okay? That's all they are. They're not investments. You can pick up that IRA with Acorns, you can do it with Fidelity, you can do it with Vanguard, and then you can use your mutual fund strategies. Most people don't know this tip right here, and this is what they do. They do number 1 or they do number 4. They leave it in the previous employer's plan, okay, and we don't know what they're doing with it, or they say, yeah, just give me the money, man, I'm out. And now they got to pay the penalties, and they're starting all over again. So the best things are to roll it over into the new employer's plan, and if that's not working, maybe it's a separation that is a termination or a layoff, and you're looking for new work, then you would simply roll it over into an IRA. There's no penalties here at all when you do that. So just a little tip. You can read more in the book. You can read more online. But my advice is do not let the previous organization run it for you. And that way you have more control, and you can use, again, the mutual fund strategies right in there and keep your retirement going. A few little things here that can make the big mistakes 20, 30 years down the road. And here's our retirement plans. Okay, IRA, it's an individual retirement arrangement. That's what the word means. That's what the acronym means. So, and then we just put the arrangement to accounts, but that's really the technical definition. They're tax deferred in the traditional IRA. Okay, we've talked about deductions and we've talked about credits. This is a deduction. So you get to do $5,000 a year, and once you hit 50 years old, you get $6,500. It's ordinary income when you use it. So basically, you invest $5,000, and at the end of the year, you can put $5,000 off of your adjusted gross income. You can withdraw starting at 59 and a half years old without penalty. Any withdrawals you make before 59 and a half, you pay the 20%, you pay your ordinary taxes, and you pay extra 10% penalty. You must withdraw a traditional IRA at 70 and a half years old. The government makes you do that. So if you have grandparents or parents that are getting near 70, and some of them may have great retirement, and they look at their IRA and say, you know what, I'm just going to keep it in there. It's good. If you don't withdraw at 70 and a half, if you go to 71, the IRS knows exactly, because they're in charge of your IRA, by the way. I mean, they have every information about it, and they know your age, and they said, well, Randy, Ray Boy, that's my father. Of course, he's passed away, but in the day, you could say, Ray, you didn't take your, you were supposed to withdraw $10,000 at 70. All right, there's a percentage that they'll give you the calculation you have to withdraw. They start penalizing that at 50%, which means a $5,000 penalty because you didn't take your $10,000 out. Good things to know right in here. Traditional IRAs are great for those rollovers. Okay, that's why probably everyone needs to have one. If you're going to be moving, you're probably very mobile in your career. You want the traditional. That way, it automatically the 401k goes right into there without any penalties, without any taxes, and you are utilizing. This is not the investment. The investments will be with Fidelity, Vanguard, Acorns, and you put it in to the mutual funds and the stocks that you would like. The Roth IRA is gold. You do not get a tax referral on a Roth IRA, which means you put $5,000 in, you just put $5,000 in. You don't get a tax deduction, but it's tax-free for life. Now that is huge. On the traditional IRA, the money that was growing was tax-free, but when you started using it at 59.5, then it became ordinary income. This one you can withdraw like a year earlier, and you can leave it in there as long as you want. You can gift it. You cannot do that with a traditional IRA, and but it's tax-free. So if you had $1 million, let's just say, in the Roth IRA, that's your money. There's no taxes at all to that. Is that sweet? Yeah. You start your Roth, my friends. Again, you can do it with the Acorns app, information that I've given you on those videos. You can do it with Vanguard. You can do it with Fidelity. Anyone you feel comfortable with. You can do it through a bank. But the sooner you can start one of these and put that money in, even if you're working part-time, you haven't got that full-time job yet, start putting those pennies in, putting those quarters in. Get your $2,000. Mom and Dad want to give you a gift. Say, don't give it to me in money so I can fund this Roth. There are some income limits. If you're single and you're banking 121, then you cannot do it anymore. And you cannot, if you're married filing jointly, 196,000 is the limit you can make before you can only do the traditional after that. So it's a great way to get a lot of people saving. So the Roth is definitely what we want. The traditional one is good, and we use it for our rollovers, or if you're just making other types of money. But this is extra income for us in our retirement. One more time, use the mutual fund strategies. There you go. Make it easy, not too difficult. The 401ks, the 403bs, the IRAs, mutual funds, 25% into these funds as you keep going. Growth, if you can, growth income, aggressive international, natural resources, whatever you have researched that you like. And with that structure, that's how you average 12% investments in the long run. For those of us, when we saw that first Jimmy and Jerry saving that money at 12%, he said, hey, you can't get 12% today. Well, that's how you do it. There are penalties anytime you take out your retirement, and I know a lot of people are doing that right now with the pandemic, with job separations, a lot of things. And I get it, man. I get it. Sometimes you just got to get to that money to survive. But here's the problem: you get a 10% early withdrawal penalty. And then you pay your normal taxes, which could be, for a working person, anywhere at the 20 to 30% range. So that's 40% right there that's taken off. So you only get 60% of what was still in the account. Okay? So be careful, be careful, be careful. Social Security, there's our Social Security card right there. It is still a major source of retirement income, and it's meant to be a part. It was never meant to be a sole source of money. You can go on, and I would suggest you do this, create your Social Security account, and so you can lock that up and find your future benefits. Right now, full retirement is 65. It's going to 67, depending on the year you were born. If you take the money out early, I believe you can start at 62. Back in the day, you could start at 55. So the government has upped these numbers because there's just not enough money in it. Anything before your full retirement, you can start, I believe, again at 62, and you would get probably like 80% to 70%. If you wait until 67, again, if you're born after 1960, right now it's 67 years old that you could take to get your full amount. Sorry, millennials, and sorry, my Zeester students and friends. is probably going to be 70 to 72 by the time if the fund is still around. It will be around, but keep yourself in good health and work. And I think that's some of it. We also have to look at in our retirement income is, yes, you can retire, you can get your 401k, 403b pension, you can get your IRAs, you can get your Social Security. But there's also jobs you can do. You could start your own side business. You could do different things, keep yourself in healthy. Some of the worst things about retirement, and I just saw it with my father when he retired at 62 years old back in 1988. He just stopped. He did nothing. And he got a lot of different problems because of that. He became sedentary, and he was such a smart person. It was just sad to see somebody wasting all that talent. And I said, Dad, why don't you get a job at the hardware store? You know everything. You're an engineer. You can fix it. I don't want to do. I just want to rest. Well, keep working. Keep your mind active. This is some information. We have that in your book too on Social Security. Again, we can just see it was funded, the New Deal Act by FDR, our president, Roosevelt. And it's just more people have come into the game, more people have been using it. And so one time there was 42 people contributing to the fund per retiree. Right now it's barely 2 people that are, so basically you and I are contributing to my mother's Social Security, or your grandparents. And that's just you, just one of you from the class. So yeah, there's some problems, but at least we know a few things. Again, some of the misconceptions: start saving early, keep yourself in the best health you can. That is, good health is worth millions in the bank. I can tell you that, my friends, because both my parents, my father went to a nursing home for 4 years. My mother is in an assisted living. We are selling everything she has right now to keep her there. We've probably blown through $1 million of their assets and retirement and everything else just to keep them, because their health was not good. They didn't keep it up. So that is my biggest advice for anyone. Work out, do whatever you have to do to keep yourself in good health and keep yourself out of those facilities, because they just drain everything that you got. All right, risk insurance. Hey, the reason we have insurance is to limit our exposure to risk. I would suspect that even Bill Gates, Jeff Bezos, Warren Buffett, some of the richest men and women in the world, I was going to say Bezos' wife, because she's like the second richest person in the world. They all have insurance, because why not? Why expose their fortunes to any other type of risk? So, again, virtually nobody has enough to ever have money to never need insurance. And insurance people do know this fact. That's why typically you get sold more insurance. It's a big part of your financial plan that you're ever going to need. So you just got to find the right amount of insurance that limits your risk to the unknown and doesn't make you broke. So these are the risk management techniques. Okay, we can avoid risk. That doesn't ever work out, does it? I'll just stay in my home all day. Even that, we know that has problems to it, because we're all doing it right now. We go crazy sometimes. Risk reduction, all right, smart. Risk assumption, that's self-insurance, which doesn't work well. But risk shifting. The risk shifting means we're transferring risk to an insurance company, and we have a deductible, all right, that the policyholder must pay on loss on a policy. All right, many of you have homes. I have a home. I just found out that my roof needs to be replaced because of the hailstorms. I had somebody trimming some trees, and they said, hey man, your roof's messed up. Immediately called my insurance company, and they sent out, I was able to get my contractors out, and I paid my deductible. I'm getting a brand new roof. So and I don't have a huge house at all, and it's over $10,000. My buddy, who teaches law for TCC, his roof was like 20 grand. And again, we just paid our deductible of about $2,000, and we've got a brand new roof and gutters all on the house. So I would much rather pay my simple deductible and what I paid every year than shelling out $20,000 for a roof. That's great risk shifting. So as we look at insurance, friends, the emergency fund. a fully funded emergency fund, and it's our step 3 of our financial plan. This is great. It's really your insurance against your financial plan. So when you have $10 to $15 to $20,000 in the bank, and all of a sudden you could say, you know what? I can start raising some deductibles on my insurance, and that makes insurance go down. If you're if you're under 21, under 25, and you're paying car insurance and you have comprehensive collision and liability, you're paying a lot of money right there. You could raise your deductible to like $1,000. That would reduce your insurance payment per month quite a bit. So that's what you can do. What generally happens is an emergency, as we talked about, if an emergency happens, and I don't have a really good emergency fund, I start going to my IRA, I start going to my 401k or any investments and quote, taking money out of those to pay for my emergencies or getting into debt. So again, the emergency fund is the great backbone of the financial plan, just like, it syncs everything together. Other insurances, I think this is a must. Identity theft. 20, 30 years ago, it was 1 in 500 or 1 in 5,000 who would ever get their identity. I think it's 1 in 5. You need it. Again, if I were to ask you to raise your hands, how many anyone ever got their identity theft? I'm sure someone would raise it. My daughter did. What I've done is got on Experian, and I have my credit locked up. Again, that counts as an insurance. My credit is locked. They monitor it 24/7. I actually had someone trying to take out unemployment benefits on me this year. And luckily, the institution caught it, so I immediately ramped my Experian up because I was just doing it for my daughter, so I did the whole family. And it is a mess when you go through identity theft. You got to get police reports. It's a lot of hassle. But this can lock your Social Security and lock your credit, so no one else can even open up a credit card or anything in your name. And when you need to unlock it, it's super easy, and then you get your credit. But somehow you need this. You really do. Health insurance, okay, is huge. All right, it's hopefully the organization that you work for will get it for you, but it is your safeguard because again, health costs. If you don't have health insurance and you have to go to an emergency room, oh man, they bill you for everything. The insurance company, if you've ever seen some of your bills and you're saying, what, $25,000? Well, your insurance company has a contract with the healthcare system, and they say, hey, here's what our contract says. We'll pay $2,000 for that benefit, emergency room, not 25. So the insurance company is basically negotiating for you. If you don't have insurance, you have nobody negotiating for you. And so you have to pay, you pay the brunt of all of those costs. So, yeah, we need insurance in our financial plan, and health insurance is a big part of it, my friends. I've known many a student, and the worst case that I came into was this 19-year-old several years ago, eating with friends. She felt really sick at 2 a.m., so she went to the ER. That made, what do we do? We're scared. We go to the emergency room. This was probably pre all the little care clinics, that have come on the scene so fast because they're much cheaper and they can do the same thing for you. She had $14,000. She had no insurance. She couldn't pay. What did she? She got all the bills. She got scared. Over time, she had to file bankruptcy. She's driving a 6-year-old car with a $645 a month car payment. $645 car payment ought to be a brand new Range Rover. It ought to be a 500 series Mercedes-Benz and above. Okay, her credit was ruined. Everything about her. She got very scared. Don't get scared. You never get scared. We get scared, but don't act on that. You go right to a hospital and say, I'm a college student. I'm broke. I have nothing. I need charity. And they'll work with you. But she ran. By the way, hospitals are very notorious for writing this off quick, and they'll send it to collections. And the collection people they send it to for that $14,000, they probably paid $1,000. They may have paid $400 for that debt, and now they can go and harass anyone they want to. Legally or illegally, they do it. 25% of all bankruptcies are filed under 27. So something in the gap. If you're out of college, you're off your parents' insurance, or if you're in between jobs, go to a insurance person and get something called short-term major medical insurance. Basically, it would have protected her. It's not for checkups and for wellness as much as it is if you get into the ER, if you get in a car accident, they'll pay up to $1 million, and that way you don't have to have that burden. You may only have to pay, 2,000 deductible. I think you'd much rather pay 2,000 than $1 million, and protect your financial plan. So. Healthcare costs in the United States, they're insane. You need health insurance. Good plan. I've got this in here. Again, you read this in your book, but generally you're looking at least $1 million lifetime maximum, and they'll pay at least 80% of expenses. And then again, once you hit your deductible, they'll pay it all. So, again, being at a few thousand versus $100,000 is much better, my friends. Now, real quickly, you've got a deductible and co-insurances. And so deductible basically is you pay the first part, or you pay percentage. You pay deductible up to again, $4,000, okay? And then after that amount, they'll pay the rest of it. Again, my deductible for my house, for my roof, was about $1,700. And so I pay that part, and then the insurance company paid the rest of a $10,000 plus roof. So I'm much happier to pay, that, and I still have the insurance. So there we go. Disability insurance. I think this is huge. Disability insurance is insurance against your income. Okay, and that is your most valuable asset that you have. You may have a great job. You may make it $100,000 a year, fantastic, and you get in a car wreck, or something happens, a disease, Lord forbid, but anything could happen, and which prevents you from working again. And so, or you may need a couple years off to recuperate. Long-term disability is usually 6 months and beyond, which means they'll cover 60%. So, if you're making $100,000, and we're using $100,000 because it's an easy number, you'll get at least $60,000 for the duration of that disability. And many times this can go all the way up to retirement if it's a severe disability. Again, I've seen so many people and talk to them that this is what did them in. They were doing great. They had their own business, and they had an accident, and they were out of work for a year, and they lost their cars. They lost everything. They had to move back home and someone to help them. It's the most overlooked insurance to purchase. If you're starting that new company that you're working for and they offer it, get it. Get short-term and long-term. It's just so easy, and it's very cheap once you're doing it with an organization. If you're self-employed, friends, it's still worth it. It's probably a couple $100 a month maybe, but again, look at your income. If you couldn't work, especially if you're in a service business, which is a great business to be in. I was in landscape business for a long time, and it's easy to get hurt in those businesses with heavy equipment. So, under the age of 60, you have a 80% chance of being disabled versus death. You need it. So, if you can get disability, grab it. If not, you can certainly buy it through a general insurance agent, and you could get that from your car. Probably the same person who does your car insurance could get you disability. Again, there's your disability plans. Make sure it's a good one, because we don't want it to work any job. It's your regular job right there. So we look at the best policy. That is, again, you're a working professional, and so that's what we want it for. That you're unable to do that work. Again, life insurance, we need that, definitely. Maybe it pays off a home or other debts. It provides education or income for your children or your spouse. Typically, you want about 10 times that amount. Funeral costs are not cheap. I've had to bury, my father, my father-in-law, and mother-in-law, and so we've got to be able to pay for some of these things at the end. We just want to make sure we have the right insurance. I think the right insurance It's just me speaking. Term is temporary life insurance, a specific period of time. Basically, your term can be a 20-year term, and that means the premiums monthly or yearly are always going to be the same. It's going to give you like 400 to 500, whenever you pick $1,000 worth of insurance for 20 years. In 20 years, a lot happens. Okay, your children probably grow up. You've worked a lot. You've got savings. The house is paid off. You may not need as much insurance as you get older. Certainly when when things are paid. So that's what makes term such a good investment. Again, if you are able to utilize your insurance from the organization when you start working, just get it. Get that life insurance. Yeah, these are little extra fees that will take out of your paycheck, but they're worth it. There's something called a whole life insurance, which is permanent life insurance. You generally get some sort of an investment, like a savings account. Be very careful of these because it's just very expensive insurance. You can get a lot more with term, and the whole life, basically, it's about double to triple the cost of a term policy. Average cost of a funeral is about 10 grand, my friends. So again, if you had 20-year term, 8 to 10 times your income, if you had 500,000, you could at least have 50,000. That could pay off your home and help your family get through. And if they invested it in some of those mutual funds, they could get maybe 50 grand a year. That's that's the best part you need. As the children grow older and they have their own jobs, again, in the end, we may get a 20-year term that's going to be in our 40s, 50s, or 60s, but then we get some just maybe a $50,000, $60,000 policy to help us through those last days there and bury us, so to speak. So if you can get it through group, that's just better. The friends for the organization that you have. If you're self-employed and an entrepreneur, fantastic. These are just the cost of business. That's all they are, and utilize that. All right. But when you're offered that with the organization you work for, and basically you can get some more every benefit enrollment period, you do that. Get your life insurances, you get your health insurance, you get to make sure your car and home are covered, and that identity theft, and things look better. Have you ever heard of credit life insurance, like your personal debts, your credit cards, your car loan, mortgage insurance? They really sound good, but most professionals consider them a ripoff because it's very expensive. And a lot of times they're only accidental death policy. So on your credit card, hey, for an extra $10 a month, we can get you, we'll pay off your debts if you die. And then you find out, or somebody else finds out, well, it's got to be accidental death. You can't die of a natural cause of anything. Now you'd have to be in a car wreck or fall off a building or something. And of course, suicide is not a accidental death. So suicides are rarely ever covered in insurance policies. 20-year term, 10 times your income. When you have that, it will cover all of that, my friends. Don't get this stuff. As the more you get into insurance, you can always ask your insurance company if they can provide a rider, okay? And that is just basically, it adds or excludes benefits, okay? Now, on this is a big one right here called double indemnity, which is accidental death on a good insurance policy. And what that means is if you have a good life insurance policy and die of natural causes, you die of something like heart attack or anything like an health related, you get your benefit. If you were to die in an accident, they would double the benefit. And that's what a double indemnity means. That's just make sure you know what you're getting. There's cost of living, there's accelerated benefits, which means also that could be a rider that, hey, you know what, my loved one, my grandparents, they're terminally ill. Is there any way we can accelerate those benefits and get them paid out like 95% before they pass away, so we're able to do the funeral, take care of their last day expenses. The details in your plan, my friends. Okay, you've got life insurance in there. Make sure that beneficiary and a contingent beneficiary is on there. For me, it'd be my wife and my daughter. For you, it may be, if you're single, it may be your parents would get it so they could pay for anything that they would need for you. These are things we don't like to talk about, but man, you wish you would have known them when the time comes. You change life insurance companies. Make sure you say, you know what, I don't like this anymore. I'm going to quit this policy and get another policy. That's fine to do, but make sure you have your other policy in place again before you cancel your current policy. Just like a job, make sure if you can, you have a job offer before you quit your other employment. So you're just protecting yourself. I have seen so many problems with this, even with friends who, his family members who did not update their beneficiary. A divorce happened, and they were married with children, and a few years passed by. Somehow they were in an auto accident, and their life insurance benefit went to the ex-spouse, and there was nothing that the current spouse or current children could do about that. So always, always don't forget those details. Xander Insurance Group, this is a Dave Ramsey company, and I've just put that up there. I think I have that link in your unit of wrapping up your financial plan. It's just, they're an insurance company that basically they're a representative of 20 other companies that they'll find rates for you: disability, life insurance, and identity theft. So it's just I don't get any money from them. I'm going to disclose that. I just think they're really good to work with. And so again, if you're thinking all this is, man, this is kind of crazy, you've gone over stuff, and I haven't thought of any of this, get with Xander and say, hey, you know what? I need some basic term. I like your identity theft, or and I might need some disability because I am self-employed. They can set you up, and they find the company that gives you the best deal. That's all it is. Long-term care. This is expensive. Again, it is insurance protecting against your assets. Probably talk to your parents or your grandparents. Usually covers 3 to 5 years in a nursing home. You probably want to purchase this closer to 60 in your 60s. I can tell you, just in a private pay nursing home, sharing a room, again, this is how my parents have lost all their money, and we've had to cash everything out. It's 70+ thousand a year just to be in a room with somebody else. That's not a great way to end it. That's going to be me at 90, and I know most of you have never seen me before, but I've kind of cynical, sarcastic humor. I just want her to push me in. That's all I want at the end, because I've just seen it. I've seen it firsthand with my parents, and so many people have had to go through. Uh, uh, Keep yourself in the best health you possibly can, my friends. These are things that are hard to come about, and I tell you who it's hardest on. It's hardest on the caregiver. It really puts us through tremendous emotional stress, mental, physical, everything to take care of our loved ones. But if your grandparents are, have some good money in the bank, and they're getting older and they don't have long-term care, it's certainly worth a call to an insurance company, to an insurance broker that says, let me see what we can do for you, because this is very expensive, and it's one of the fastest growing industries around right now. Could be some really good jobs if you love older people, geriatrics, and you like to take care of them and working with them, because they are fun to work with. They really enjoy being around people. There's some really good jobs out there. Property and liability, again, disasters, hurricanes, tornadoes. This is why you have it on your property. You are mitigating your risk. If you have a mortgage, you must have it. I have known people who have paid their homes off and done nothing to them. That home, as long as you keep your insurance, keep it up, it's money in the bank, especially in today's world. It appreciates in value. So make sure you're doing everything you can to keep that home in amazing shape. This is why we have it. This is why we have the insurance. These are property losses, all sorts of risks out there. And insurance companies can certainly come in and help you mitigate that. And that's why you want to have it. Again, your structure is your personal property. You do that household inventory with documentation in case anything was gone. And usually people come in, you can just take pictures of everything. That's all you really got to do now. Just video everything in your home and keep that video up in case something happens. Say, hey, here I had 5 computers, I had this TV, we had jewelry, we had some antique furniture. Make sure it's all in there with that documentation. Of course, you've got that umbrella policy, liability if someone gets hurt on your property. Yeah, that's my father said. Hey, the joys of homeownership. You know, um, your personal protection ranges from like $100,000, or possibly you have a big umbrella. It's a catastrophic policy that can help personal liability coverage of $1 million of liability. Again, if someone's on your property, if they get hurt, for some reason, believe me, people want to sue, and these insurances can certainly help you with that. There's a whole chapter on insurance in the book, and it's a great one to read through. Don't get too overwhelmed with it. You get the stuff you need, and it covers you very well. What about me? You're saying, hey, I live in an apartment or a cool place in Fort Worth, and I really don't want to buy a house. Well, you can still get renter's insurance, all right? Because there's damages right there. What if the plumbing leaks above you and ruins your couch, your furniture, your computers, your tech? Yeah, and you have to basically move out while this gets repaired. Renter's insurance, and it's a very big one right now. So you may be able to do it through the apartment complex that you're renting through, or you do it through yourself, and you can see only 40% of renters have that insurance. And or again, theft is a big one too. If you get your stuff stolen, it is with the right policy, you have that protected. Well, there's your Porsche Carrera right there. Yeah, what's gap insurance? Most people finance a car. This is going to be very important for you. It can be brand new or just barely used. Okay, you got to have auto insurance. We know that. All right, but the gap insurance basically puts it from your loan amount to the actual payout amount of the car. And so you bought a Honda Accord, a nice, pretty new one for $30,000. You financed all of it because they allowed you to. 2 years later, somebody T-bones you, and their company comes up, their insurance, and they say, hey, you know what? That 2-year-old Honda Accord, we basically put it at $25,000. And you say, yeah, but I still owe $29,000 on it because I haven't paid that much. I had low payments at first. They don't insure you to the loan amount unless you bought that insurance for yourself. That's what the gap does. The gap is the middle of that. So if there's a $5,000 difference and it's a pretty new car, the gap usually covers that. So, there you go. Just make sure you're not overpaying. I have an old friend here who basically had tons of money in the bank. She was in her 80s, and she was paying $2,800 a year for a minivan. And that minivan became 6 years old, and she was still paying the full amount because she had full coverage, zero deductible. And she had a little dent in her door, and they said, they paid for it all. I'm so happy. I had great insurance. And I go, Erling, how much you pay a year for that? About $3,000, $2,800. I go, 6-year-old minivan, you've been paying that for 6 years. You have $18,000. You probably could buy a minivan. She was paying way too much with the money she had in the bank. She should have been paying $800 a year or $400 a year on it. So just keep that in mind, my friend. The older that car gets, do we need all the insurance on it? We know we have to have liability, but do we want all the comprehensive and collision as well? Or are you have enough in the emergency fund just to buy another cash car? Those are things to think about. And as you're younger, again, my friends, you're going to pay the highest insurance out there. You're just going to, unless you just buy a cash car and get your liability and say, you know what, I'm going to save some money, and then when I get over 25, that seems to be the biggest year for young people in the insurance world, that you actually get a better discount. There's everything else in your collision, all right, and your property damage, okay? You have to have the minimum liability. Again, when your car's in an accident, regardless of whose fault, you grab their insurance, you take pictures of it. I've been in a wreck before. I've called the police, and they have been very helpful to help me get in. And you'll end up. There's a lot of legwork you have to do, okay? But just make sure that your insurance is there, and then you get their insurance as well. And again, the coverage is limited to. Remember, there's always depreciation in those cars. So have that emergency fund ready, my friends. Yeah. You may want that. Again, your comprehensive physical damage. Uh, if anything else happens, that's theft or vandalism, wind, hail, falling objects. Again, the newer the car, the more insurance you have. The older the car, we just tend to go down and just have our liability. So I hope that helps in insurance. These are some of the things to avoid: the accidental death, the mortgage protection insurance, the credit card protection. Again, if we die, we want all of our deaths to be covered in that, not just accidental. And then the last right in here, duplicate health insurance. If your spouse partner has insurance, both of you do, and they're two different companies, all of a sudden you say, hey, well, you take mine and I'll take yours as well. We'll have two insurances. Be careful, because insurance companies protect themselves. And if they say, hey, Randy, you had Blue Cross Blue Shield and you had Aetna through your wife's, well, we're going to say Aetna's going to pay for it. And Aetna's going to say, no, 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 no. Blue Cross is going to pay for it. And so who ends up having to pay for the bill while these companies, which are multi-billion-dollar organizations with lawyers, fight it out? They're going to come to me and say, you own it. You owe us money. So be careful on duplicate health. You can have co-insurance, but duplicate health is not a good idea. As we are wrapping up our financial plan and we're looking at estate planning as well, if you are over 18 years old, you should have a will, and that is a traditional will. The reason being, your will is the only thing that can speak for you when you are dead. Nothing else can. Your best intentions and the things you would like to have seen done on your estate must be in a will. Unfortunately, 70% of Americans die without a will. And if you die without a will, that means you die intestate, which means without a will. And so the state, for instance, the state of Texas, will have to determine who should receive, your worldly possessions. And if you're, very young and you're still living with your parents, then yeah, I can see why a lot of people get away with that and don't do it. But if you're married with children and if you have a blended family, you can see the complexities of what can happen. And if you want any say-so in how your estate is to be settled, friends, you need a will. And I have the link for you. It is legalforms.com or legalformsusa.com. It's in your links of your financial um, web links, and you can get one done there. You can just download it for about $75, a state of Texas will, and then you can have it notarized, and you're in good shape right there. Your will need to go through probate, and that basically just for $300 fee in the state of Texas just says that, okay, Randy's things go right to his wife and his children. So again, it's how you transfer property. You know, you want this to speak for you, and that's the best I can say without giving too much legal advice, because I'm not a lawyer, but a will is very important. And in that, you would also get a power of attorney, a durable power of attorney, and that is for someone who can basically carry out your business if you are incapacitated to do so while you're alive. So those are some of the things. It's a great chapter in estate planning to look at, but let's get that will. Let's do this. Let's put out a I love you list, and that is, we all have people we love, and if we pass on and we don't have any instructions, it's not treating them very kindly, is it? So if I die, boom, here's here's a list with phone numbers of my life insurance, my IRA, the account numbers, investments, retirement, credit cards, funeral arrangements. Shop around on funeral arrangements, especially if you're a caregiver for somebody else. I have been that for my father-in-law, my father, my mother-in-law, and that's an expensive game in the funeral world. And there's some really good ones out there that don't charge too much, and you can easily spend 15 to 20,000, and you can spend around 5,000 and still get a very, very nice funeral. And in today's world, they're mainly going to be graveside services. So, but have that ready to go. Put everything. Go to online, Amazon, eBay, Walmart. Get yourself a good-looking case like that. It's fire and weatherproof. Put your will in there. Put your I love you list. Put your investments, your birth certificates. If you're married, get your marriage license. Anything that your Social Security cards, your passports, put that in there and have it somewhere in your home that you can easily get in case you need to grab it quickly. Again, make it fireproof. That way, unfortunately, if any damage came by storm or fire, that's going to survive it. And you have everything in there, and you check this, my friends, every few years, every life event, children, marriages, we add to it. Make it real simple. College planning, hey, make sure you graduate. Average salary increases are $15,000 per year with a college degree than without one. That's just average. Unemployment rate has been under 6% for college graduates. Now, we're not taking into effect the pandemic, but even in some of the bad times of the recession that we had in 2007 to 2013, college graduates with skill sets did very well. Non-college graduates, it was up 20% of an unemployment rate. So it's worth getting that degree, but now we have strategies to do that, don't we? We're going to do it with very little college debt. Excellent. The summary, my friends, we've made a long journey as we just started this last video, and it's an ongoing personal finance crisis in America. I truly hope that this course has helped us in some small or even large way. Would be great that we're thinking differently. Hey, 70% of Americans are imploding, and from what we have seen and been through in these last 15 years, it has been very difficult just to make it. So, government's making it worse, in my opinion. Remember, our money is somewhere between 80% behavioral, all right, 20% intellectual. We're going to focus. We tell our money what to do. We do our best to live within our means. We do our best to reduce, possibly eliminate all of our debts. Fantastic. We save aggressively for the unknown in our emergency fund. And we systematically start investing for long periods of time. Even if it's that $20 a month, that's going to go a long way throughout your career. And then we hopefully bump that up. We will have financial peace. What if this is a Dave Ramsey quote, what if you were debt-free? What if you had 10, 15, 20, 25,000 bucks in the bank just for the unexpected, and you're fully funding your retirement plans, and you're building some wealth and investment, some of that financial freedom. That's what we're hoping to have, my dear friends. Never, ever, ever give up. Those are the words of Winston Churchill. And for those of you who studied Dunkirk, you understand why he said that. That saved the British Isle from the invasion of Nazi Germany, and it was the turning point of the war. You never give up. It's a war we're living in right now. It's a strange war of this pandemic. It's a strange battle that we face every day, and it can get rough, and I've been down, but don't ever give up. Again, I hope you can take at least one idea from this class, and at least one, hopefully many, and apply it to your daily life. I do teach other courses, very, very friendly courses, I believe in the same format as of this course. Principles of marketing and business principles. So if you're a business major, or if you're just or been interested in the business world, these are two fun and they're very good courses for you to take, and you can move those on into your degree. The saying is from a Persian king who asked his wise men, give me something that will last. Give me a saying. Write something down that will last throughout the ages. And they came back with this quote, and it was one of my father's favorite quotes. And this too shall pass away. It will, my friends. I don't know when. We're going into some strange times, but it will pass away, and I think we'll come out stronger. Hopefully you will come out stronger. We all will financially, and things will get better. Let's hold on to hope. It's the only thing left in Pandora's box. It's been a great semester. I thank you for taking the class. I hope you enjoyed it, and I do hope that I will see you in some of my other classes at Tarrant County College. All the best, my friends. Thank you.